Then you have the government, right? The government has two primary interests. One is an interest in job creation. Industry is a great mechanism to provide jobs to the public. Secondly, industry is a great source of tax revenue for the government. So these are two primary interests of the government. The industry must provide employment, and the industry must provide tax revenue, must give tax revenue to the government. What happens if the industry is not able to do these things? Then there could be two problems. One, the government may decide to impose punitive taxes on the industry. These punitive taxes will force the industry to adhere to the interests of the government. Or, in the worst event, the government may decide to take over the company. The company may be expropriated, right? So, the government could, in the worst event, resort to these two tactics, which would go against the interests of the company. And finally, we have the public. The public is a stakeholder in the company. When the company sets objectives, the company must ensure that those objectives are acceptable to the public, as those objectives are acceptable to all the other stakeholders within the company. All stakeholders, both within as well as outside the company. Let us look at the interests of the public. The public is primarily interested in ensuring that the industry does not add to pollution in the area where it is set up. And secondly, that it provides jobs to people who live in that area. These are two of the cardinal interests of the public. You may recall an instance where Coca-Cola, which had a soft drink plant in Kerala, right? And that plant, the people living around the plant, people living in the locality around the plant, were convinced that that plant was depleting groundwater resources from that area. So they resorted to mass action, right? They resorted to mass action, and ultimately that plant was closed down. Sometimes the public may pressurize the government through other means. They may pressurize the government through electoral means. They may pressurize the government through refusal to pay taxes. So there are various ways in which the public can pressurize the government. So if the objectives of the company, if the objectives of the business are not acceptable to the public may react negatively. And this is how those negative responses would impact the company. So what we have seen now is that there are several stakeholders in the company, right? And when the company sets up its objectives, it must ensure that these objectives are broadly acceptable to all these stakeholders. It is true to say that not all stakeholders are the same. some stakeholders are more important to the company than others. How do we determine which stakeholder is critical and which stakeholder is less important to the company? Now, one way of looking at stakeholder importance is to look at the ability of the stakeholder to disrupt the operations of the company. It is possible that some parts of the public may resort to actions which disrupt the operations of the company. It is possible that employees may sometimes resort to actions which disrupt the activities of the company. It is more likely that the public or employees may give rise to these kind of actions. That's more likely than that a bank will do it, because there are certain agreed methods of resolving disputes with banks. Therefore, it is unlikely that the bank will disrupt operations of the company. So, one way to look at the importance of a stakeholder is to look at the ability of the stakeholder to disrupt operations of the company. Now, let's look at another criteria. This is the ability of the stakeholder to create uncertainty. Business does not like uncertainty. A stakeholder like a bank, for instance, certainly has the ability to create uncertainty. It creates uncertainty by delaying payments. It creates uncertainty by increasing interest, right? So, these tactics could result in a situation where there is a certain atmosphere of uncertainty created within the company, and the ability of the company to function in the proper manner is impaired. The third criteria, which gives you an indication of the importance of the stakeholder, is the ability of the company to replace the stakeholder. Now, let's look at a chemical company, right? Or let's go back to the Coca-Cola example, right? Now, Coca-Cola had a plant in Kerala, and the people around that plant objected to the plant. So what did Coca-Cola do? It stopped that plant and relocated that plant elsewhere, right? So in this case, the stakeholder, that is the concerned public, was replaced, was changed, right? The concerned public was no longer the public in Kerala. It was the public in, let us say, Gujarat, right, where it did not have this problem. So, if the company has the ability to replace the stakeholder, then the importance of the stakeholder is less, right? Let's take another example. Let's take the Reliance refinery in Gujarat, right? Now, this Reliance refinery, in case there are issues with the Reliance refinery, in case the public living around that area has problems with the refinery, that public cannot be replaced, because Reliance cannot shift that whole refinery out of Gujarat, right? It's a huge investment. Therefore, in that case, the particular shareholder, that is the particular stakeholder, that is the public, is an important constituent. It's an important stakeholder. Okay, right. So, in this section on objectives, we have looked at the importance of objectives for a company. We have looked at the issue of different kinds of objectives, and we have looked at the issue that objectives must be acceptable to a wide variety of stakeholders within the company.